These are my conclusions for this year. I do expect that this year is going to be a bullish year. I believe that the first half of the year could be stronger than the second half of the year. My favorite sectors for this year are and the US dollar has fallen, and also interest rates have started to drop because tariffs have not been as widespread as was reported or thought. So still right to be bullish and overweight. So when I started looking at technical trends, studying breadth, identifying stocks are starting to act well as a group and act better, then it didn't matter if the economic news was bad or not. If the stock market was starting to trend higher, then those trends tend to work on their own. Thank you very much for joining me today. It's a pleasure to host you here in New York City and have you join our office. And so thank you very much for your appearance. 2025, it's an interesting year. It's gotten started off with a lot of challenges, and I think there's also a lot of opportunity. And so I am going to be speaking largely based on technical analysis, not fundamental or macro analysis. I joined Tom Lee 3 years ago and have been working doing technicals for the firm. I've been on the buy and the sell side of the business for the last 35 years. So I've worked as an options trader, worked with Morgan Stanley and with a hedge fund, and now I'm fortunate to have had a chance to work with Tom. So it's and John Bay for that matter also. So very wonderful group of people, and very happy to talk to you today. My goal here is just to try to educate you a little bit on how I see the world and talk about what I think are some of the biggest opportunities for this year, as well as what we need to watch out for that might be warnings. These are my conclusions for this year. I do expect that this year is going to be a bullish year, similar to Tom Lee. However, similar to Tom, I believe that the first half of the year could be stronger than the second half of the year. My favorite sectors for this year are industrials, financials, technology, and discretionary. My thinking is that the US dollar and also Treasury yields should be in the process of peaking out and should fall likely throughout the year, which is almost exactly opposite of what most people thought coming into 2025. I think there will be opportunity this year for emerging markets as the US dollar starts to turn lower. And so that should be good for many different areas of the world that had underperformed prior to 2025, meaning China, India, South Korea, Mexico, that had been lagging. I think they'll now start to appreciate in the months to come. Typically this year, the first couple years of a new presidential cycle can be challenging. Nobody knows what the policies, how they'll actually turn out to be based on what was promised. And so there's always a transitionary period, both this year and next year. They tend to be not as good as typically the pre-election year and the election year. We still are in a year where technology likely can outperform. We have seen growth come back very sharply in recent months and outperform value, particularly on the large cap side. And how we say in English, the Magnificent Seven, some of these larger companies that have changed all our lives for the better, in my view, can still outperform for this year. I don't think there's sufficient signs of deterioration to think that this entire group is starting to turn down. The thinking around the new administration was that there would be very dangerous for the stock market and potentially very dangerous for the world in terms of tariffs and this and that. But honestly, that has raised fear to a level where it should provide optimism. And I think it's largely been overblown and is not as detrimental to the economy as what the media has been saying lately. The thinking was that Trump would come into power and immediately interest rates would go sky high and the dollar would rally because of tariffs. And in the last month and a half, we have seen precisely the opposite. The US dollar has fallen, and also interest rates have started to drop because tariffs have not been as widespread as was reported or thought. And so a lot of this is just a bargaining chip that doesn't end up being reality as much as what the media would like the world to think. So yet again, we enter a new year with a lot to worry about and a lot of things that make us feel uncomfortable. The world is dealing with a lot of divisiveness and polarity, and my thinking is that this can still be a very good year, and that a lot of this pessimism is actually good news for investors because we haven't seen sufficient signs of deterioration in the U.S. stock market. So these are just my sector ratings for this year. They're sectors that have started to strengthen in recent months, that being consumer discretionary, which largely lagged throughout much of the last couple of years, is now starting to come to life. So we're seeing the booking companies, some of the hotels, some of the airlines, so they're all starting to show recent signs of outperformance. So I think that's actually very promising to suggest that the consumer is still in good shape. It might be bifurcated. The lower end has been hurt by inflation, high food prices, high gas prices, but on the upper end, things are still in very good shape for the most part. So discretionary is still a very, very good sector. Industrials, to its credit, we saw the Dow Jones Transportation Average rise to new all-time highs last year for the first time in about 4 years. So that's also very, very important. We're seeing the shipping companies, the truckers, the rails all start to come to life. And so that's very good for the industrial sector, which also tends to benefit in a rate cutting cycle. And so we're in a cycle right now where bad news is good news. Bad economic news, meaning that yields start to fall and more cuts are put into the curve, is actually good news for the stock market. Financials is also a sector that is an overweight for me, and many of these banks should benefit from deregulation as well as tax-friendly type policies that benefit the consumer. And finally, technology, which we've spoken about. And I know there's some fear of late about DeepSeek, and I'm not certain that is meaningful enough to derail the semiconductor sector, nor think that technology is starting to show sufficient damage that would make one avoid it. So still right to be bullish and overweight these sectors that we see in green on the left-hand side. And I think there's a lot of promise for these to be overweights for this year. These are my sectors and favorite areas for outperformance and also underperformance. I might highlight that energy I think is an underweight for this year. I think the combination of a weaker than expected Chinese recovery, along with the U.S. ramping up our own energy infrastructure, raising 3 million barrels a day potentially, is going to cause a huge amount of supply in a year that generally has weaker demand for crude. So I think the crude could fall to $50 or even lower. And I think that means that energy is going to be an underperformer and not an area to overweight. This slide simply shows the pre-election year seasonality. And so I hope you can see those figures. But basically it shows that this year typically, along with next year, likely is going to be a lagging year compared to the pre-election and election years. So we've had 2 back-to-back years of over 20% gains, which is very, very good. And many are wondering whether this can continue. And my basic point is that I don't think we've seen technically sufficient signs of rolling over, meaning fewer and fewer stocks hitting new highs and technical weakness to think that this market is going to be derailed just yet. So we need to see more to have evidence that this is going to be a negative year. Many people have said 2 years up and the next year should be down. And it's very, very, based on my own technicals, it's unlikely that is going to happen like the media says. Here's just an intermediate term trend of the S&P over the last 2 years. So we see that trends remain in very good shape. And so we don't see proper evidence to suggest that the stock market's going to really start to turn down. We've had a little bit of a churning here, but my thinking is until we see sufficient weakness, it's very difficult to fight the trend and think that the trends truly are going to start to turn down. That's the one thing that I tell all investors, just to keep track of longer term trends. I look at a number of different things. I look at technical structure, I look at sentiment, I look at cycles, I look at the sector rotation, and the combination of these still suggests that this can be a good year, although it might be a choppier year than last year. So I'm not sure that we get gains of 25%, but my thinking is between 10 and 13% for the year is really my target. So my target for the year is 6650 for the S&P 500. I think that's attainable as the economy is basically in a sweet spot right now, meaning inflation seems to be under control and should actually fall. However, both yields and the dollar falling should actually be quite positive for the equity market. Let's start with the basics. Technical analysis is the study of price action along with sentiment, seasonality, basically looking at charts in order to help you make decisions about the future. And so I have been doing technicals for over 30 years. And my experience is that it is possible that to look at charts and make decisions based on momentum and based on studying whether the charts are going higher, lower, or sideways in and of itself is very, very valuable. Many people fundamentally might like a stock, but it's under severe pressure and the volume is much heavier on the declines. And even though it might have a good fundamental value, it's almost impossible for that value to be realized because there's a lot of selling pressure in terms of higher volume on the downside. And so the stock might be in a downtrend and unfortunately can never truly realize its value until that starts to change. So my job is just to look at the supply and demand of the market, that being equity market, commodities, currencies, treasuries. And I also look for correlations on what's been working with the dollar, with yields, with stocks, to try to say, okay, this is, I try to find the leaders at any given time of various sectors. These are the stocks that are at or near all-time highs that are starting to accelerate and showing good momentum. Last year was a very good momentum year, and I've learned from experience that it's better to favor momentum than it is to have a mean reversion strategy to try to pick the ones that are at the very bottom thinking they're going to come back. That's a very difficult game, to think that the worst performers are going to suddenly turn out to be the best performers. That takes a lot of time. It's more like 2 steps forward, 1 step back, as they say. Technical analysis allows one to take the blindfold off. It helps you to line up the technicals with the fundamentals. So at any time you see whether the stock is starting to appreciate with good volume and can join and help a stock or anything, any asset, reach its value that with the fundamentals might say it's possible. So I always think it's a benefit for investors to make use of technical analysis, at the very least to understand the trend of what you own, because sometimes it might take months, if not years, of realizing that value. Even if the fundamentals are bullish, the stock might not get there, whereas the technicals will give you that added benefit of seeing something as it starts to really appreciate. I first got interested in technical analysis about 30 years ago, right around 1995. I realized that fundamental news didn't always cause a stock to go higher when it should. What the Federal Reserve was saying about the economy didn't always coincide with the economy, with the stock market rising. Sometimes bad news in the economy would lead the stock market or stocks to go lower for reasons that I didn't understand. So when I started looking at technical trends, studying breadth, identifying, stocks are starting to act well as a group and act better, then it didn't matter if the economic news was bad or not. If the stock market was starting to trend higher, then those trends tend to work on their own, so without any sort of fundamental explanation. So basically, in a nutshell, I use technicals to identify some of the best performing stocks and there are plenty of people that have written books about this over the years on how to really buy stocks using technical analysis, ones that can truly appreciate. So I started there, and I used technicals when I traded options in Chicago. I was a market maker on the floor of the CBOE, and so at that time it's important to know how to use direction as a tool if you're trading options, to be long gamma, meaning you're buying lots of options, calls and puts, or short gamma, and you don't want the stock to move, and that's also useful where a stock reaches a certain level and you expect it's going to slow down. So using technical tools can be very helpful also when trading options. This is just a chart on the correlation between treasuries and equities. To my earlier point, we've entered a society now where bad economic news has actually been good for the stock market, because as news starts to get bad, people think there's going to be more and more rate cuts, which in turn will stimulate the economy. So this period here talks about yields and stocks. In other words, yields are negatively correlated with stocks. So as yields go higher, stocks go down. As yields go lower, stocks rally. So we've been in that area really since the last 2 years, but it's not always that way. Sometimes you would think that good news should be good news for the stock market and bad news should be bad. But right now it's all about the Federal Reserve and what their plan is for this year in terms of their rate cuts and how that will materialize. Here's a chart of the US dollar. We've seen recent breakdowns, and this has happened literally in the last 2 weeks, and this is going back since last spring. So a big move in the US dollar, and now it's actually started to break down pretty substantially. So I expect to see at least a move down in the next 3 to 5 months, and maybe sooner, where the dollar is really going to start to pull back. And we're seeing the same thing with dollar yen. So dollar yen has started to break down. We heard reports from the BOJ about inflation and UEDA and the fact that real yields are very low. They anticipated CPI would be 2.4% versus 1.9%. So they're going to start to hike rates pretty quickly in the months to come. So the yen should really start to move higher, meaning dollar yen should really start to fall. So I think that that's one of the bigger takeaways of the last month, is that we've seen a very material breakdown both in yields and also in the US dollar, which should be beneficial for emerging markets and potentially for commodities also in that regard. This is a chart which simply highlights the difference and disparity. It's a ratio of the US versus the MSCI All Country World Index. So just in the last few months after Trump was elected, we started to see some huge outperformance. So momentum really started to shift positively on US performance. And I think that is important and suggests that the US, at least this year, is probably still going to be an outperformer. Even if we do get some temporary emerging market strength. I think that as a year, it's still going to be a year for technology, and that's going to cause US outperformance. Here's a chart of EEM, and China makes up about a third of this. It's about 30%. So after a big pullback from 2021, we've seen a gradual rally, and even in the last few months, this specifically happened as the dollar and rates were starting to rise. Now that is starting to change. We've pulled back and hit support, and now that's starting to act a little bit better. I expect to see this break out, which means we'll see very good strength in emerging markets as the dollar continues to fall. This is just one example, India, which has sold off sharply, and I think that at current levels it makes sense to consider buying India. It's pulled back, in the neighborhood of 15% or so from the highs, which is a big move to the downside after years of outperformance. So I think that the fact that the dollar is rolling over now is going to support markets like India, and I'll show you another couple. China also is starting to show evidence. Same thing. It sold off as yields were rising and the dollar was rising. Now the dollar is starting to roll over. That should benefit China, along with the fact that Trump seems to be a little less severe with tariffs with Xi. I think that they've spoken, and my own thinking is that they worked out an agreement that will be a little bit more beneficial for China. And so I think that the FXI, they certainly need a lot of stimulus, China, but at this point, I think it's right to be bullish after this pullback. It looks like it's on the verge of breaking out, and dollar weakness should drive outperformance in China. Small caps, Tom Lee has been very bullish on small caps, and my thinking is that this is a work in progress. Technically, I've not seen sufficient proof to be bullish yet on small caps. They've been in a range. This is a relative chart, so it compares the IWM versus the equal-weighted S&P. So the ratio has been largely still range-bound for the last 2.5 years. So this is a case where Tom Lee, using the fundamentals, very bullish, saying they're very cheap. I don't disagree, but technically, I'm not yet there. So it's going to take some time. And I still would be in favor of large cap growth and technology, and I think it's still a little bit early for the small cap trade. I think that's probably a Q2 to Q3 event this year where we start to see IWM really break out and show its potential. Momentum has outperformed every other style. These are the different styles that one can favor: momentum versus quality, growth, dividend, low volatility. Momentum has consistently, over the last 10 years, outperformed everything. And even over the last year, momentum has sharply outperformed. So this is very good for technical analysis. So this very makes a great case that one should be owning those stocks that are leading, those stocks that are at or near highs, not trying to buy the ones that are deeply depressed and hoping that they come back. We're still in a momentum-based style right now where that's still showing very good signs of outperformance. So I look at growth versus value. This is large cap growth versus value. These are ratios. So large cap growth versus value on a large cap basis, it's clearly showing preference for growth versus value. When we look at a small cap or even a mid cap basis, you can make a better case for value over growth. So value has been showing outperformance over the last year in mid caps, and also in small caps, we see that value, this is growth versus value, has actually not been doing as well over the last year. So that has favored some of the recent outperformance in financials, which make up value, as well as energy, and the fact that technology started to lag a bit last summer. So small cap generally has not been as conducive towards growth. But overall, many people, since growth dominates the larger indices and ETFs, it is right to say that we're still very much in a growth framework where growth can work and outperform. And this is just a table that shows the degree of outperformance of the Magnificent Seven compared to the broader indices. And so as you can see, these seven, in this case 8, or the 7 with Google being really 1, have shown dramatic contribution to the S&P last year. So it's important to account for the fact that that's happening. Many people try to outperform the benchmark averages, and if you don't own these stocks and they're working, then it makes it very difficult to be a portfolio manager and have the same alpha or degree that you can outperform the market. Whereas if they're underperforming, then it makes it a little bit easier. So in the last 2 weeks, we have seen both NVIDIA and also Apple have actually fallen. So, the indices have been weak, and it's still very much a stock picker's environment. The correlations are very low. So those that are skilled at picking stocks that can beat the Magnificent Seven do stand a very good chance of outperformance. But the big picture, the key takeaway here is that it's just important to understand the degree at which these stocks have all shown dramatic contributions to S&P performance. And my thinking is that's still something that's going to continue. Charts of Alphabet, Amazon, Microsoft, Meta remain phenomenal technically on a short-term and intermediate-term basis. So I have no reason to think that relationship is going to change. This is something that sets me apart from other technical analysts, in that I try to look at relative pictures of the sectors versus the S&P, and it gives one an edge if you look on an equal-weighted basis because you're taking out those larger cap names that have such dominance, that really make you unable to see what's happening with the actual sector. So this, for example, is industrials, and on an eco-weighted basis, you see industrials versus the eco-weighted S&P. So we're taking out all the large cap ones that influence these indices and just looking at the pure trend of industrials, which has been very, very good. And that's continuing to be the case. We've seen breakouts in stocks like Deere, breakouts in GE just in the last week. Very, very good for the industrial sector, and one of the reasons why I remain very bullish on this as a group. If this starts to break down, then it's something surely that we'll pay attention to, but for now, industrials remains an overweight and something that one wants to still favor. The next few charts, I will run through them quickly, but they're very similar. I just want to show you how these sectors look versus the S&P, and that will basically show you why I like them. So a similar explanation. Many of these are trending very well, and technology, for example, has not shown proper evidence of breaking down, even though the semiconductors have been somewhat weak of late. But we see, trends of technology have still been good. This is since last July, so it's been choppier, but lately technology has really come back to life, and we see momentum also having turned positive. So a big period over the last couple of years of consolidation that has led to a big breakout in tech, and my thinking is that's still very much a positive for technology.
Is this equal-weighted tech?
Yes, it is. So that's important to say because we want to take out the Apple, the NVIDIA that represent 10% because it distorts the picture when you have all these in a ratio form. So we want to look at the pure equal-weighted sectors. This is just Magnificent 7. It shows we have been churning a little bit, but trends are still very positive. This is a ratio of software versus the semiconductors. So interestingly enough, this happened last summer where we saw relative outperformance break nearly a 5-year downtrend, meaning we want to favor the group that broke out, in this case software, which is actually much stronger than semiconductors as a group. So the recent deterioration in some of the semiconductors has caused this to turn much higher just in the last week. So I really like buying or owning software. If you have to own technology, you want to own the Palantirs, the Microsofts, the CRM, the Oracles. Those are very, very good companies versus thinking you want to buy AMD or Intel or some of the semiconductors that have really lagged. And so, there are semiconductors like Broadcom and TSM, which are phenomenal stocks, really, really good. Even NVIDIA, I would argue, is still very, very good. But in general, software is preferable right now in an area of outperformance within technology. The next few are just breakouts of things that make me, I find these favorable. Financials just broke out literally in the last 6 months out of a multi-year downtrend. So this makes financials, in my view, quite attractive when I see equal-weighted breakouts. Consumer discretionary also has started to show a lot more strength of late, so that's also a very good sign. Healthcare broke almost a decade-long uptrend, so unfortunately this group has become an underweight. In the short run, meaning the next 1 or 2 quarters, I do suspect that we're in a mean reversion period where healthcare can bounce, which often happens at the start of any year. We see the laggards start to outperform and lead, and we see the leaders start to lag. In this case, healthcare as an underperformer has started to gain ground just over the last couple months. So, we can see maybe a few months of outperformance, but in general, this goes back since 2011. So over a decade ago, huge period, and this underperformance needs to change before we can say healthcare truly is going to show outperformance. Energy also is an underweight for reasons we discussed earlier. The sector has grown very weak in the last 6 to 12 months. We have seen a little bit of a mean reversion bounce, but I think that proved short-lived. So crude oil right now has pulled back pretty sharply, but still the trend has not been great in the last couple of years. So it could have one final move to the mid-80s, but then my thinking is technically, and the cycles support this, so the crude oil cycle is actually bearish. I've taken it's important to understand. So this is amplitude, not magnitude. It doesn't matter that this goes all the way up. It's more the turning points that are more important itself than the than the extent to which this swings. And so I looked at the last 20, 30 years of crude oil, the highs and lows, and created a cycle composite. And this still shows a very big downward bias that likely lasts into probably this coming fall. So I think crude is still going to have a pretty big decline in the next 6 to 8 months or so of this year. Precious metals I'm more optimistic on for this year. I think that with the Fed cutting cycle, we should see gold and silver push back to new all-time highs, and that likely happens in the next 6 months or so. So I'm pretty optimistic on the metals. There's also an important message here in that rates likely are not going to remain low forever. So on any giant pullback in rates that lasts into the summer or fall, if gold gets up to 3280, my thinking is it might be right to sell the metals in the second half of this year. So it says bullish for first half. Second half, if rates start to turn back higher, then that could be damaging for the precious metal trade. Cryptocurrencies, my thinking is it is a bullish year, but I think Bitcoin is extended. I think the sentiment has gotten way too optimistic. Every 5 minutes I'm getting a notification on my smartwatch that Bitcoin's at 100,000, so I think that's a problem for those that are long. The cycles that I show for crypto show that we can have a correction that likely starts in February into March. And so at that time, I think there'll be opportunity on pullbacks, but the cycle for this year for crypto says that we're likely going to see consolidation and not an immediate gain. So this goes against what our digital asset team and also Tom, they're very bullish for this year. I'm also optimistic, but my target is like 135 to 150,000 for Bitcoin. And I think the first quarter has the potential to be down. So I think even though equities can rally and the correlation has been strong, I think crypto probably is going to lag a bit and actually could fall starting next month. I want to talk about breadth a little bit. This is important for markets. For now, we've seen a little bit of a correction in breadth in the last 6 months, but I do not feel that's too damaging thus far. So this is a percentage of stocks above their 200-day moving average. Basically, breadth has shown some near-term pullback, but I don't think it's that damaging. Sentiment has gotten more subdued in recent months. I spoke about this earlier in the presentation. We're nowhere near the peak of sentiment. This is a time when we are very optimistic. This was in 2021. That preceded the bear market of 2022. This also was 2017. We had some choppiness in 2018. Last year, we were a lot more optimistic than we are now to start the year. I look at things from a contrarian perspective. In other words, a pullback in sentiment like that, I view as generally being something that's good for the stock market. This is CTA positioning, commodity trading advisors. So this has dropped very sharply since the election took place. When we hear news of tariffs, ongoing wars, we're not sure about what the Federal Reserve's plan is for the rate cuts, has caused the allocation to equities has dropped pretty sharply in the last couple months. So that's actually a big positive. As the market starts to work, that money is going to have to be put back to work and could drive potentially $15 to $30 billion to come into the U.S. stock market. So that's important because as sentiment gets very subdued and we have all these trend followers and commodity trading advisors that retreat, now as the market starts to move up, and I think it will in the next couple weeks, that should be something that causes, it should be a tailwind for the equity market as exposure is raised back to normal levels. Here are a few sentiment gauges. One is the Fear and Greed Index. This just shows that things have pulled back very sharply since October when things were greedy, and this is times of pessimism, of fear. So right now we've pulled back a lot in the last, 4 or 5 months. That's actually a pretty good thing for the equity market. People have gotten more concerned, whereas the trends are fine. So in general, that translates into a buying opportunity when that happens. Similar story, this is from JP Morgan. This is a global equity sentiment indicator, and so it's pulled back very sharply from last year, and now it's more neutral. So all these sentiment gauges are really saying the same story, that sentiment has gotten subdued, it's retreated in recent months. So from an equity investor standpoint, with no trend damage, that's actually something that's we want to see, is negativity and fear, because that's generally a good time to invest in. This is the Commodity Futures Trading Corporation, so it shows the basically what leverage funds have done to exposure, and it shows that they've all started to retreat. So right now, the net longs in the S&P right now that are not the commercials, the sort of the speculators, have gotten negative by 78,000 futures. So it's dropped pretty substantially. So this just goes along with the other charts I've shown with sentiment and positioning to show that things have gotten a little more subdued in recent months. Equity to put to call. This is something I study. It's the one thing that's a little more optimistic. We've seen the put to call drop over the last year, equity put to call. So this is a 13-week moving average. So when it tends to get very, very low, that's a sign of concern. That means that very few puts versus calls, more calls being traded. This is times of high put trading, which marks equity market bottoms, 2009, 2016. This is a time of a market peak, a stock market peak, when the equity put to call drops. Now this has gone down, which is interesting, except for the last week. But in general, the trend has been lower, which one would expect with a rising equity market. We don't want to see this get to really, really low levels. That would be a concern. I think that's probably a 2026 event, probably not something that happens this year. I'll conclude by giving you some warning signs. Many people conclude with saying these are signs of optimism. We know that this year should be a good year. This is what to look out for to suggest that things might change. We always want to know where the risk is. And in this case, I listed 7 things, what I personally look for. I don't think any of these things are present in the equity market except for breadth starting to roll over meaningfully. So we haven't seen structural weakness yet. That's still fine. Equity markets are in good shape. We haven't seen bullish sentiment. If anything, it's been the opposite. Sentiment has pulled back and gotten more subdued. Technology has not broken down. Technology is the #1 sector within the S&P. 30% of the market is tech. Breadth has contracted, but recently in the last 2 weeks, we started to see that improve. High yield have not widened meaningfully. That's also something. The fixed income market will always give you a warning sign for the equity market and start to turn down first. Defensive trading has not strengthened. Consumer staples remain at multi-decade lows versus the market. If we think the market's going to really weaken, we want to see consumer staples start to really strengthen, and that hasn't happened. So that's also fine. And finally, Treasury yields remain. We never got above 5% in the 10-year Treasury, and now it's starting to pull back. Treasury's started to rally, which is actually comforting to risk assets. So the bottom line is these are the things that would make me concerned. And as of now, there's only one of them which really has started, and the majority of them still are in good shape. That is all I have for you today. Thank you very much.